Hi YouTube, welcome back to the Rage Money Community YouTube channel. I'm your host, William Zhang. Today, we're gonna talk about the market conditions that we're in and the potential drawdown that we could witness if the US debt ceiling crisis becomes a black swan event that does not get resolved. And one key data point we're looking into is the margin debt level. And one important data we're looking at is the margin debt level in the market. Back in June to July, we saw a dip in the debt level, margin debt level in the market. So people started speculating, okay, maybe this is time people start taking profit, deleveraging, taking a risk-off approach, and we might already hit our peak in margin debt, and therefore the stock prices will, we can call it a top in July, August time. But surprisingly, in August, margin debt actually had an uptick again, and it's up 8% in August, hit another all-time high. So the market condition right now is a lot of margin debt and people buying things on margin, buying stocks on margin, and trading futures. I'm not sure about futures, but I know trading regular stocks, people are buying stocks on margin, and it's at historic high. And in a scenario like this, what we really gotta worry about is an unexpected downturn that forces people on margin to liquidate their positions to meet their margin call, and therefore forcing other entities to liquidate their positions and go into margin call. And that scenario is called deleveraging. And usually with deleveraging, you see a sharp decline in asset prices. We can take a look in the 2020 March level. You can see that margin debt wasn't that high either at the time. We see a sharp decline in margin debt along with the sharp decline in the SP 500 value. So that's why I want to bring this data up, because in a black swan event like that we're predicting in the US debt ceiling crisis, if the market condition remains current, meaning that if in September during the Evergrande scare, Evergrande panic, people didn't deleverage and withdraw their funds, and we remain at one of the historic highs in margin debt levels, we might really see some sort of a very, very, very sharp decline very fast, because the panic in the market causes massive deleveraging of margin positions. But what I'm predicting is that what I really see is that there are a lot of money on the sidelines as well. There are a lot of people, a lot of institution buyers who just waited back in March, March of 2020, expecting to drop more, but they missed the boat. So they are reluctantly putting money slowly back into the market. But the market rallied so quickly, they couldn't really say, oh, I want to get full risk on and try to gain a maximum exposure that way. And that's why they put a lot of money on the sideline and the whole cash and waiting to see a major dip. So every dip will get bought up quickly. But in this case, I expect a massive and a quick flash crash that will get picked up rather quickly. I can call times, I can call extend, we can do some technical analysis to try to predict some levels, and give you some confidence level and probability of the market hitting that. All right, so this is the E-mini S&P future as we predicted in our last video. We said that there's this trend line that we broke during the Evergrande panic, and it will probably meet with some selling pressure as we approach that level. And as you can see, this line remains here, and obviously we try the buyers try to come in, the bulls try to take over and climb over that trend line and try to get back on the uptrend. And however they failed, now they meet with like a sharp decline, a sharp selling, with some decent volume picking up, and this is today. Well, the new day of the futures market started about like, I think 5 p.m. or 4 p.m. Eastern time. So this is considered a new day, and this is we're looking at a potential downtrend for the next couple of days, and see if they can rally from there on. But the point of this segment is to try to analyze if the black swan event happens, what sort of levels are we looking at, and when would be a good time to close our short positions, where would be a good time to start buying some dips, and what will be some moves that I'm considering. Obviously, technical analysis works. I think the data people give is about 60% of the time, and it really depends on, since buying a stock, buying a stock goes up 50% of the time, goes down 50% of the time, and if you have an edge of 60% using technical analysis to get 60%, so you have a 10% edge, and in the long run you actually make money if you keep the bet sizing the same, obviously. And so in this case, let's try to do some technical analysis and find some levels that could be our support, that we can like close out our short positions. So the first one we're looking at is the 200-day moving average. Let me just make sure. Yep, it is the 200-day moving average. So once we hit around like a 410 level, we might start closing our first short position, or a small portion, or like even majority of our short position. It depends on the rate of decline. If it's like one day, let's say we're in October time, and then the US entered default, and then we just saw a 5% down day, a 5% down day, another 5% down day, hitting the 410 level, I'm probably closing 80% of my short positions and waiting for it to bounce back. Maybe might even pick up some long term, some micro future to wait for the bounce play. And another level, so let's put a support level down right now. I would say around this level. Oh, don't like this tool. And let's make it this thing and green. So we know this is a buy level. If we see a drop into this level. And another level we're looking at is another previous resistance around this level, which is about 390, 395-ish level. That's another if we see a sharp decline into that level, that's definitely a buy the dip level that we're looking into. And those are the two levels that I'm looking at. If we see a sharp decline rather quickly, that I will just close out majority of my short position and even go long from there. If it's like a slow burn or something like that, we might see or if it's just a shallow retracement, we might see that it's just gonna be finished around here, around the 420 level. That we can close out maybe like 30% or like 50% of our position, depending on the rate of decline at the time. And next one we're looking at is probably the weekly chart, just to make sure that we're following our the support levels on a longer time frame. So yeah, when we see a decline into the 420 level, this might be a good place to close a small position of your short position. Another one is near 408, marking on the daily. So now it shows up here. So I think this one might be the 50-day moving, 50 weekly moving average. It's about the 400 level. So maybe we can put a support there. 400 sounds like a really good for the whole number that might be a support for a lot of people as well. Around this level, yep. And another one is down in the like a 390s level. Yeah, and I'm not sure if we're gonna hit that level. It seems like it might be like maybe like 5% of the time we might hit there. Just throwing some random number out there, right? This one might be like maybe like 10 or 15% chance hitting there. This one might be like, okay, maybe 50%, or in this case 50%. This might be like 30%. So obviously these numbers are just randomly thrown out. We can definitely look at the market pricing right now and determine whether those levels are reasonable. So now, since we finished the technical analysis, I want to give a little recap on what happened today. So last Friday, House passed a bill to try to give government funding and raise the debt ceiling. Obviously, they knew it wasn't going to pass in the Senate. And of course, today the Senate voted on it, did not pass, meaning that if we don't get any funding for the government might go into shutdown this Friday or after Friday. And it will be much more difficult to try to come together and come up with a plan to raise the debt ceiling. And those are expected. So this week is so important to watch from a news level and a technical level, and see what is going on and what is going to happen with the U.S. government. And on the topic of the margin debt, obviously we're at all-time high, but we also have the lowest interest rate in history, meaning that money is so cheap, people just want to take on debt and borrow and buy on margin, and expect earnings to be higher, and expect that consumer will spend more. Those are all logical decisions, and that really explains why the margin debt level is high. But also adds a lot of speculations into the market. People expect perfect earnings report, expect perfect numbers. We're trading about, I think last time I checked, it's like 25 or like 29 PE ratio for the Qs, QQQ, the Nasdaq, and something around 27 for the S&P. Even though it's not like historic high, but it's in the high end of the expectations. And so in this sort of environment where people take on margins, even though it's logical, it's a logical move to make, it will still create an environment where if some sort of unexpected event happens, it will create, and then if that doesn't get recovered quickly, it will create a sharp decline in the market. And that's what we're watching for. That's what we're trying to predict and trying to aim for. And I just think that given the volatility level, given the margin debt level, and given the political situations, if the U.S. debt ceiling does not get resolved, we really could make a high return on our small investment. I know I mentioned I wanted to create a bet sizing video. It's actually a complex concept, and it will take me a lot more time to create that video. So I will try my best to try to create something maybe like this weekend or something, and see if I can get enough screenshots, enough data points to support that, or to teach that concept, the Kelly criterion concept. I'll put it in the description so you can take a look at it yourself and learn about it just even without me. And thank you again for watching the video. I really appreciate all the likes, the dislikes, the comments, the engagement. I just love to blog my trading concepts and macroeconomic understandings, and hopefully you find this helpful and you will subscribe to the channel and just hit that like button. Thank you.